Hi there, everybody. All right. Today's discussion is going to focus on what is a butterfly, whether it's a put butterfly, call butterfly, how do you set one up, pluses, minuses, and then also how does that differ from something that we trade often called a broken wing butterfly, broken wing put or call butterfly. So let's first dive into a regular butterfly and what a butterfly is. So in a butterfly position, a long butterfly position, what you're really trying to do is almost hit the bullseye, or kind of put the tail, pin the tail on the donkey, if you will. What do I mean by that? Well, let's take a look at Tesla here for a second. Let's say we're bullish, and a butterfly can be set up with any sort of direction, any sort of bias, bullish, bearish, or even neutral, Okay, so let's say we're bullish and we want to go out here to next week, the April 14th expiration. Okay, so the first thing we're going to do is what we normally do with any sort of setup is we look for what is the expected move. Right? What is the market pricing in an expected move over a certain period of time? So we're going out to the April 14th expiration. So what we're going to look to do here is look at the at-the-money straddle for April 14th. The at-the-money straddle for April 14th, if we look at the 11:35 call input option here, we come up with roughly $87. Okay, what that tells us is the market is currently pricing in Tesla, a move to this expiration April 14th of plus or minus $87. Okay, we don't know what that move is going to be, but the market is telling us the size of the move with a 68% probability. Pretty good. So with the stock trading 1135, $87 expected move, let's say we're bullish, we're going to target roughly 1220-ish or so. Okay, so why is that? So with the stock 1135 and an expected move to April 14th of roughly $87, we are going to target 1220. So great, we want to target 1220. Well, with every strategy that we trade, everything, every signal that we put out there, the goal for any one of our spread strategies is for the stock to move as close as possible to the short strike at expiration. If that happens, that maximizes our profit potential. So in this case, since 1220 is our target, we know that's the option we want to sell. Okay, now in a butterfly consists of three options. Okay, and again, they can be puts, they could be calls, could be bullish, could be bearish. We're going to use call options here since we are bullish. And a regular butterfly is always in a 1 to 2 to 1 ratio. Okay, buying 1, selling 2, buying 1. Also, in a regular butterfly, the distance between the strikes is symmetrical. Okay, what does that mean? What does that mean? Well, let's take a look at Tesla here. Okay, we know that the 1220 is the option we want to sell because that is our target. That's where we hope the stock goes at expiration. So let's create a $20 wide butterfly, and we could create anything we want, $5, $10, $20, $50 if we want. The key is that the strikes are symmetrical, meaning the distance between the first strike and the middle strike is the same as it is between the middle strike and the last strike. Okay, so in this example right here, we are going to create, so we are creating the 1200, 1220, 1240 call butterfly. Okay, the strikes, as you can see here, are symmetrical. So what we are really doing with the 1 to 2 to 1 ratio, okay, when you break this down, and so many people get afraid of the name of a particular option spread, a butterfly, an iron condor, a strangle, a straddle, and think, oh my God, that is too complicated. You know, I can't trade that. You know, I'm too much of a beginner for that. Well, when you break a particular strategy down to just its bare bones basics, okay, and you break a butterfly down to its basics, what you really have are two different spreads. Okay, we have a long 1200, 1220 call spread, and then we have a short 1220, 1240 call spread. Okay, this right here is the equivalent to this 1 to 2 to 1 ratio. Now, why would you ever do that? Why would someone ever do that? Okay, if we think the stock is going to 1220, you can create any sort of call spread you want. Obviously, the wider, or the bigger the distance between the long and the short strike, the more expensive that's going to be. In this case, what we're doing right here, okay, what we're doing right here is we have two vertical spreads, a long spread and a short spread. We are selling the 1220, 1240 to help finance the purchase of the 1200, 1220, with, again, the goal being that the stock moves to that middle strike, which is the strike we identified as where that expected move is. So let's look at the pricing on something like this. Okay, if we were to price this out, we can see that the midpoint of this market between the bid and the offer is approximately $1. Okay, 90 cents, $1, which certainly seems pretty cheap, right? To have some really nice upside exposure for $1. Well, that's one of the nuances of a butterfly. Okay, our butterfly spreads are typically, and I'm going to put in quotes here, cheap. What does cheap mean? What does cheap really mean? Well, how do we measure expensive or cheap? Well, we have to measure that really by the reward to risk. Okay, exactly. The reward to risk. Okay, so when I say this is cheap, if we can buy this spread for $1, okay, what is the maximum value of this particular butterfly? The 1200, 1220, 1240. What is the maximum? Well, the maximum any spread can be worth, any vertical spread, meaning where the strikes are within the same expiration, so not a calendar or anything like that. Right, the maximum value is $20. Okay? It's $20 because if the stock went to the short strike, at expiration, our 1200, 1220 call spread will be worth 20, where the short spread that we used to finance the purchase of the long spread is going to be worth 0. So the maximum value is 20. So that means from expensive or cheap, our reward to risk is 19 over 1 or 19 to 1. Does everybody see how that is 19 to 1? Because if it is worth $20 at expiration, we can make 19. All we can ever lose here, all we can ever lose is the investment we put into this of $1. So even if the stock were to go to 0 or the stock were to go to 10,000, all we could lose is $1. And likewise, regardless of where the stock goes, this can never be worth more than $20. So when we typically look at reward to risks on different types of spreads that we're trading, we've discussed this before, we're sometimes looking for 2.5, 3 to 1, maybe a little bit more than that. But you can see here on a butterfly, you're getting a massive amount of bang for your buck. So what does that tell us, right? If we put on a position that has this massive, massive potential, what is that telling us? Well, it tells us that the probabilities of that happening are pretty low, which is why I said at the beginning of this conversation, this is kind of like hitting the bullseye or kind of like pinning the tail on the donkey. Okay, and that's the way that butterfly spreads work. And that's a reason why traders love butterflies, because they're typically very, very cheap. They provide huge reward to risk, but they don't always come into play at that size maximum gain. Now let's go through what the P&Ls would be on something like this here. Breaking this down, it means we bought the 1200 call and sold the 1220 call. That's the first part of our butterfly. The second part is sold the 1220 call and bought the 1240. The reason why we buy that last strike, okay, the end of the butterfly, is for protection. Okay, it gives us our maximum risk, and we always want to know our maximum risk going into any position. What would happen if we just bought the 1200, sold 2 of the 1220s, and never bought that last strike, that 1240 call? What would happen there? Well, in this case, if Tesla really, really flew, okay, really just exploded beyond all our strikes, we have unlimited loss. We have unlimited loss because we're short one option, short one call if we didn't buy that 1240 call. Remember, a butterfly is always done in a 1 to 2 to 1 ratio. And that's so we have an even number of long options that we bought, and an even number of short options that we have sold. This way we can always identify what our maximum exposure is. Okay, so let's go through a couple scenarios. What happens at expiration if the stock is, okay, and I'm going to put a couple scenarios here, okay, anywhere below 1200, what would happen to the value of this butterfly at expiration? It'd be worth 0. That's because all of the options would be worth 0. Okay, so again, our maximum exposure, our maximum risk is the $1 that we paid for this. Okay, what if we're at 1205? This is just going to equal $5. Our long part of the butterfly, the 1200 1220 spread, is worth $5. The short 1220 1240 is worth 0, so this would be 5. Okay, for a profit of $4. Remember, we've paid $1 for this. What we're looking at right here is just the value of the butterfly. Okay, so the math is pretty simple. Let's say we're at 1211 at expiration. The value of this is going to be $11. If we're at 1218 at expiration, the value of this is going to be $18. And then obviously, as we spoke about just a few minutes ago, at 1220, the short strike, the maximum value is going to be $20. So what happens if we start going past the short strike? And that's where a lot of traders get, I guess I'll use the term freaked out. Okay, they start getting really nervous because all of a sudden they have a short option that's in the money. And they get really concerned that, oh no, what happens if I get assigned? Okay, so let's take a look at this. Okay, what happens if at expiration the short option is in the money? Meaning, what happens at 12.22, let's say? Okay, what would the value at 12.22 be? Well, the long option would be worth 22. The short options would be worth $2 each, for a total value of $18. And so on and so forth. Let's go up to 12.31. Okay, at 12.31, the long option would be 31. The shorts would be 11 each. So that equals, $9, not $10. That equals $9. 31 on the long, each short worth 11. 31 minus 22 is worth $9. And as we get closer and closer and closer to the end of the butterfly strikes, the 12.40 in this instance, the value of this position is going to keep decreasing. Okay, so at 12.38, we have $38. The shorts are worth 18 each for a value of $2. And then at 12.40, okay, the magic of 12.40 being the upper end, the long is going to be worth 40. The shorts are worth $20 each. So the overall value is 0. What happens then at any price over the top strike at expiration, the value is going to be 0. And that's where the beauty of a butterfly comes in, that when you do it in this ratio 1 to 2 to 1, and the options are symmetrically placed like they are, you can never ever lose more than your investment. The value of the spread, the value of the butterfly, okay, can never be worth less than 0. And so let's just randomly pick a number of 1,300 at expiration. Okay, your long would be worth 100. The shorts, they'd be worth $80 each. But then we have that other long option. Remember at the end, the last wing. Okay, so that 12.40 call would be worth $60. If I add that all up, that's plus 160 minus 160, still for a price of 0. So butterfly positions, they can be very speculative, but speculative because hitting the nail on the head, hitting the bullseye typically doesn't happen. But the reward to risk is phenomenal. That's why butterflies are very, very inexpensive ways to play a position, a directional position. The key is, number one, the options have to be in a 1 to 2 to 1 ratio. You can do it 5 to 10 to 5, 100 to 200 to 100, but you have to have the same amount of long options as you do short options. And the width between the strikes have to be symmetrical. You can choose whatever expiration you want. The further out in time you go, a little bit more costly these butterflies will be, just like any position. Typically, when you buy more time, the positions will cost a little bit more. The closer in to expiration, the lower that reward to risk is going to be. The further you go out, the higher that reward to risk is going to be. But again, the key is we are always 100% risk defined. Always 100% risk defined. All right, everybody, we are now going to talk about the ins and outs and why we would do something called a broken wing butterfly. We've already talked about kind of the nuances, the strategy behind what a butterfly spread is and why we would do it, what the reward, what the risk is. And now we're going to dive into a broken wing butterfly. Okay, so again, you can create this type of position, whether you're bullish, bearish, or neutral. So what we're going to do on this one, since we already talked about a bullish butterfly potential in Tesla, let's look at a bearish potential broken wing butterfly. Now, let's review real quickly. What were the setups, the nuances of a regular butterfly? Okay, so a regular butterfly was a 1 to 2 to 1 ratio. But the key was that the distance between the strikes are symmetrical. Okay, so the long might be $5 wide, the short $5 wide, 10 and 10, etc., etc. The difference between a regular butterfly and a broken wing, and actually before I go into that, let's talk about why the wing. Okay, in option terminology, the wings of a spread, okay, are known as the outer options, the outer strikes. Those are the wings. The middle, okay, is known as the guts. That's, trader terminology back from the floor. So the wings on the outside, the guts in the middle. Okay, so the wings on a regular butterfly are equidistant from the guts, from the middle. But in a broken wing, the difference is the wings are not symmetrical. Okay, so it's still a 1 to 2 to 1 ratio because we still always want to lock in and know that we have our maximum risk defined. So we still need to have an equal number of long options and short options. But in a broken wing, what we look to do is skew the position directionally a little bit more. Okay, again, could be bullish, could be bearish, but by skewing the strikes and having a longer spread, or the long spread, that is wider than the short spread, it gives us more delta or more direction. So let's take a look here. Okay, and let's take a look at QCOM. Okay, we're just going to take a look at QCOM. And now remember, we're going to assume, that we are bearish. Okay, so if we look at, again, April 14th expiration, QCOM is trading right at 152.5 right now. So if we look to see the expected move, okay, which is the first thing we always want to do because we always want to get a target as to our short strike. Okay, so if we look at the straddle, adding together the call and the put option of the at the money strike at the expiration that we're looking at, we see that it's about $8. Okay, that's adding together the call and the put. It's about $8. Okay, so QCOM is trading 152.5, and expected move to the April 14th expiration is $8. Again, expected move does not tell us which direction a stock is going to move. It only tells us the size of the expected move with a 68% probability. So assuming that we are bearish, we are targeting 144.5 at expiration. Okay, now I tell you, there's not going to be a 144.5 strike. So what we want to do in that instance is always target the strike closest to where we think the stock is going. In this case, we could either choose 144 or 145. We're going to keep a 145 just for symmetrical, for mathematical purposes here. Okay, so if we were putting on a bearish butterfly, a regular put butterfly, we might put on the 150, 145, 140. okay, where our long put spread is $5 wide. Short put spread is also $5 wide. Okay, so a normal butterfly might be the 150, 145, 140. And we could do that, you could see, for right around 70 cents. Again, we're trying to hit the nail on the head. We're trying to pin the tail on the donkey, right? 145 being the optimal place. But let's say we're right in that the stock goes down because we were bearish. But what if the stock flies down through the lowest strike here? Then that spread could be worth zero. So the benefit and the difference of using a broken wing butterfly, it gives us additional direction, and since the strikes are not symmetrical, if the stock trades past the last strike, there will still be value to this position. Okay, try and think about that for a moment. In the Tesla example, when we went through a normal butterfly, and I'll just bring that up for reference here in a second, okay, we had the 1200, 1220, 1240. What happened if we got to that last strike of 1240 or even higher? The value of the spread was zero. That's because the long spread and the short spread were equidistant. Okay? But in the case of the broken wing butterfly, we might do something like this. Rather than the 150, 145, 140, we might do the 150, 145, so that's $5 wide, but then on the short side, maybe only do the 143. So what's going to happen if we tighten that up on the short side there? Well, it's going to make this more expensive, first of all. So you can see the price of the spread went up by about 40%. It went up from 70 cents to about $1, $1.05 or so. But let's really see what happens. Okay, so the broken wing is the 150, 145, 143. Still in a 1 to 2 to 1 ratio. Okay, when you break that down, what do we have? Okay, breaking it down, we have a long 150, 145 put spread, $5 wide, but then on the short side, we only have a short 145, 143 put spread. $5 wide on our long, $2 wide on our short. So it's not symmetrical on either side. So what does that do for us? Why would we ever want to put on a position like that? Well, we still want the stock to move to our short strike. As we've mentioned before, in every example, every position we have, we still, in a perfect world, have our maximum potential reward at the short strike. That still holds the case here. But now, if we start moving beyond that short strike, we still make money even if the stock goes beyond that last strike. Okay, so let's go through some examples here. So let's say we bought the 150, 145, 143, and we paid $1. Anything above 150 at expiration, what's this thing going to be worth? It's going to be worth zero, right? Because all the options are going to be worthless. Okay, let's say we're at 147. Okay, our long spread's going to be worth $3. Short spread's going to be worth 0. So the value of this butterfly will be worth $3. What you'll see here is the max is still going to be at the short strike. So at 145 at expiration, it's worth $5. Now, what happens if we start to move down below that short strike? Yeah, we're going to start giving back some of that value. So 144 at expiration, the long spread is still worth 5. The short spread is worth what? Let's break it down like we did in the butterfly example. The long 150 put is going to be worth 6. The short 145 put is going to be worth 1, but we had 2 of those, right? So the value is going to be worth $4. At 143 at expiration, the long option, the 150, is going to be worth 7. The short 145s are worth $2 each for a value of 3. Now, that's going to be our magic number. That's going to be our magic number, which I'll work through here in a moment. But if we go back to the strikes up here, okay, knowing that we have a long $5 spread and a short $2 spread, we can tell from that if the stock went below the lowest strike, this will never be worth less than $3. Where in the regular butterfly, once we hit that end strike and it went beyond that, the spread was worth 0. So let's play this out here. Let's say the stock goes to 140. Our long strike is worth 10. The short strikes are worth 5 each. Okay. But then our long 143 strike is worth 3 for a value of $3. Let's look at 100. Okay. If the stock is 100 at expiration, the long is going to be worth 50. The shorts are going to be worth $45 each. And then our long 143 is going to be worth 43 for a value of $3. So what a broken wing butterfly does, costs a little bit more. We still look for the stock to move to the short strike. But what it does is on a move further beyond the end strike, we still make money. Whereas in a regular butterfly, we don't. That's why a broken wing put or call butterfly, either way, costs more than a regular butterfly. It's still the same basic concept. We still do it in a 1 to 2 to 1 ratio. We still have one long spread versus one short spread, but just the difference between the spreads are not symmetrical. So it gives us more direction. That is really the big difference between a regular butterfly and a broken wing butterfly. We're going to have a discussion here on implied volatility. And so many traders don't even think about implied volatility because honestly, it sounds really difficult and it sounds really confusing and it sounds too advanced. But I will tell you, as an expert in volatility, when I say expert, I mean that because I get called upon by the CBOE, by the CME, by many of the major news channels out there to talk about implied volatility and what it really means. And without truly understanding it and then being able to use it in your arsenal, okay, if you don't use it, you are really missing out. I have experienced firsthand how people can be, let's say, long some calls because they think a stock is going to go up and the stock goes up massively and they lose money. Or long puts because they think a stock is going down and the stock does go down massively and they lose money. All because of implied
volatility. So it's imperative to understand implied volatility. So let's talk about this, all right? And I'm going to use the whiteboard here. What is implied volatility? Okay, basically implied volatility tells us how expensive or how cheap an option is based on history, based on its historical trend of premium. Now, we all know that the higher the volatility in anything, not just option trading, but the higher the volatility in anything, that means things are swinging around all the time, right? That means things are back and forth and back and forth. So things that are more volatile typically cost more. Things that are less volatile, when things are complacent, cost less. Same thing with options. And what we'll see is on any particular stock here, we can see a volatility chart. And I'm going to pull one up here on Apple. Okay. So if we look at this chart here, which is now just implied volatility. Okay. It looks like a stock chart, but you're going to see trends. You're going to see trends, highs and lows. Okay, highs and lows. Now, implied volatility is something that is called mean reverting. That's right, mean reverting. What that means is, mathematically, it's always going to find its average, its mid-level. So when it's really, really high, 100% of the time, it's coming down. And when it's really low, 100% of the time, it's moving up. And you can see that on this chart here. I just drew the kind of the top range, the bottom range, and you can see how volatility will find its center point. Now, the key as traders is to know how to take advantage of that. And not to make this too easy or too simplistic, but essentially, you want to sell when something's expensive and you want to buy when something is cheap. It's no different with implied volatility. Okay, so let's get back to our whiteboard here. IV, or implied volatility, always has a range. And as I said, implied volatility is mean reverting, which means it will always find its average price. The key is to know when to sell, when to buy, when to anticipate volatility going up, when to anticipate volatility going down. That's kind of just a very simplistic overview. Now, let's get into how we actually measure implied volatility. We've already spoken about delta, and we know that what delta represents is how much the price of an option moves as the stock moves $1. Well, the Greek measurement in option trading for volatility is called Vega. And it's really easy to remember that because you've got Vega volatility, V and V. Okay, what Vega measures is how much the price of an option will move as the as the implied volatility of an option moves 1 point. Okay, so let me put that up on the whiteboard here. Vega measures the move in the price of an option as implied volatility moves 1 point. The higher the Vega, the more that option is going to move. The more that option is going to be sensitive to a move in volatility. The lower the Vega, the less sensitive it is to a move in volatility. Now, let's talk a couple things about Vega, okay? As an option gets closer and closer to expiration, the Vega decreases. So volatility becomes less important the closer and closer you get to expiration of an option. delta really just takes over as you get towards expiration. Okay, the further out in time, the more vega impacts the price of an option. Okay, let's take a look at how. Let's take a look at why. Okay, I'm going to go back to our Apple example here. We're going to use Apple. And we're going to look at an option that expires just out in a week. Okay, and right now, Apple is trading 175.60-ish. Okay, if we look at the money options here, which I've just circled here, I've got a column here that says Vega. Tells us what that volatility sensitivity is. And you can see it's right around 10 cents. Okay, 9.8, 9.7, that means it's 10 cents. What that means is for every 1 point that the implied volatility in Apple moves, the value of that option is going to change by approximately 10 cents. If the vol goes up, the value of that option is going to go up by 10 cents. If the value of that implied volatility goes down a point, the option is going to lose 10 cents. Okay, now the implied volatility right now in Apple is 40. That's measured in percentage terms. That's 40%. Okay, let me put this on the whiteboard now. Okay, so we've talked about Vega. Implied volatility is measured in percentage terms. Now, 40%, you may not know what that means. I don't know if that's high, that's low, that's, somewhere in the middle. Well, that's why we use our implied volatility historical chart here. Okay, so if I look right now at an implied volatility of 40% in Apple, man, that's way up here at the top of its range. If I look at this graph, if I look at this chart here, okay, that volatility is absolutely going to decrease. It is absolutely going to come down and find its middle ground. Now, the key is we don't know whether that's going to happen tomorrow, the next day, next week. We do know it will happen, but this is something that we need to learn about reading charts. But if we see that the implied volatility in Apple options are trading 40%, we can look at that and say, that's really, really expensive. The more expensive the volatility is, the more expensive options are, the more premium that options will have. Okay, now, we just looked at Apple has an implied volatility of 40%. All right, Scott, great, it's 40%. What does that really mean? What does it mean if it's 20%? What does it mean if it's 80%? Okay, what implied volatility measures is the expected move in a stock over the next year. Okay, think about that for a second. Implied volatility measures the expected move, what the market is pricing in a stock over the next year. So with Apple trading, in this example here, Apple was trading 175. The IV was 40%. If I do some simple math here and take 175 times 40, okay, I get $70. So what the market is anticipating, or what the market is pricing in right now, is that over the next year, the market is anticipating an expected range in Apple of the current price of 175 plus or minus that expected move based on the implied volatility, which is $70, or a range of 105 up to 245. Okay? Again, 40% implied volatility. That measures what the market is anticipating a move in a particular stock would be over the next year. So we can see if Apple was really cheap, Apple volatility, that is, okay? If Apple implied volatility was down at the bottom of its range. What do I mean at the bottom of its range? Okay, right down here, right around, let's call it 22, 23% implied volatility. Okay, if we do the same math, we're going to see what the expected move would be. So we do the same math, 175 stock price times 0.23 now. Okay, 0.23, we get an expected move then over the next year of only $40 roughly. Okay, or a range of, again, 175 plus or minus 40-ish, we're just going to round that off right now, equals a range of 135 up to 215. So if we compare this, right, if we compare the 40% implied vol, which gives us this range right here, to the 23% implied vol, which gives us this range, we can see the wider the range, the more expensive options should be, right? Because the probability is that that stock can be all over the place. So what this tells us again, and most people don't understand what implied volatility measures. What implied volatility measures is the market's anticipation for how wide of a range a stock will trade in over the next year. The wider that expected range, the more expensive those options are going to be. The tighter that range, the less expensive options are going to be. So what does that mean for our everyday trading? What it means is we want to look for strategies to sell options when vol is really expensive, or credit spreads collecting in money. And we want to look for strategies to buy options or to buy volatility when volatility is really cheap. Because we know that when it's down here, it's moving up. And when it's up here, it's moving down. Again, we don't know the exact timing of that, but we know that is going to happen. And we need to be able to use and to understand this past performance, right? Historical data of volatility ranges to predict the future. And without understanding that, your trading profits can get seriously impacted. Hopefully everybody understands that right now. I know that, volatility can be, pretty confusing, but we must understand that. The bottom line is you don't want to buy vol when it's really high. You don't want to sell it when it's really cheap. Okay. Now let's see how volatility actually impacts the price of individual options here in Apple. And we're going to look at these options again here. The 175 calls are on this side, puts are on this side. Now, one other thing to understand and to know about volatility, about vega, okay, is the vega of an option is the exact same for both a call and a put at the same strike at the same expiration. The vega of a call and a put option are the exact same at the same strike and same expiration. Okay, if calls and puts moved differently from a volatility standpoint, okay, not from a delta standpoint, but from a volatility standpoint, there would be a massive arbitrage. Okay, it just doesn't happen. I shouldn't say it doesn't happen. It does happen in the instance of some very extraneous circumstances, like if a stock is hard to borrow, as we saw some of the meme stocks earlier this year, where you couldn't short a stock, then you may see the volatility of put options perhaps being greater than call options. But generally speaking, and for probably 98% of the cases, that Vega number, the amount that the volatility impacts an option, is going to be the same for a call and a put. Let's go back here. And we're going to focus in on these 175 calls right now. Okay, the 175 call, again, has a Vega of almost 10 cents. Again, that means that for every 1 point the implied volatility changes, the value of that option is going to change 10 cents. Okay, so let's look at this example on the screen. Right now, we can see the current price of Apple of this option, of the December 23rd 175 call option, is about $3.88. The implied volatility of that option is about 40%. The Vega is almost 10. If I adjust this implied volatility by just 1 point, up or down, we should see the value of this option right here change by roughly 10 cents. So watch the middle part here. I am going to decrease the implied vol, and look at that. The volatility, or the value of that option, went down by about 10 cents. Now I'm going to increase this implied vol by 1 point, and you can see the value of that option went up by 10 cents. So what this tells us is we know that if we're buying expensive volatility, the likelihood is it's going to come down. And the value of the option that we just bought is going to go lower. Same thing if we sell volatility when volatility is down at the bottom end of its range and the likelihood is it's going to go up, then the option we've sold could become worth more. Now, for comparison purposes, let's focus in right now on the put side. Okay, the put side, the December 175 put, has the same implied vol, 40%-ish as the call. And that put right now is trading about 407. That Vega is the same, of about 10 cents. Okay, it's same, about 10 cents. So if I go in here and I change the implied volatility on that put, if I lower at 1 point, you can see that the value of that option just dropped by about 10 cents. And if I were to raise it 1 point from where it was, you can see the value of that option just increased by about 10 cents. So same thing happens to the call and the put. Okay? Very important to understand that Vega is the same for both a call and a put, with the same expiration at the same strike. Okay. Now, other properties of Vega. We already talked about how the closer we get to expiration, the less impact vol has on an option. Okay, and that's reflected by its Vega. The further out we go in time, the higher that Vega, or the higher the volatility impact is going to be. So the further out in time, the more impact Vega has on an option. Let's take a look at that. Okay, we were just looking at December 23rd options that had a Vega of about 10 cents. Let's go out 1 month. Okay, let's go out 1 month. Look at the same exact option here, the 175, but just 1 month later, and you can see that Vega has basically doubled. It's about 21, 22 cents here, which means for every 1 point that volatility changes, that impact on that option is not going to be 10 cents. It's now going to be 21, 22 cents. And if we go even further out in time, let's look at June options. Okay, same example here. Let's look at the 175. Now that Vega is up almost 50 cents. Okay, so you can see the further you go out in time, the more sensitive options are to a change in implied volatility. Okay, remember that. The further you go out in time, the more sensitive an option is to a change in volatility. Now, besides just looking at length of time to look at a change in volatility, it also really matters where that option is. Is it at the money? Is it in the money? Is it out of the money? Okay, well, let's look at what's called a volatility curve. Okay, again, at the money here, meaning what option is kind of right where the stock is trading. At the money is 175. And we can see that that Vega is about 10 cents. The further you go away from that strike, either up or down, so either in the money or out of the money, you can see how the Vega gets less and less and less the further you go away from where the stock is trading. So the volatility impact on an option becomes less and less the further in the money or further out of the money that you go. Okay, so not only is the volatility impact or Vega greater the further out in time you go, but volatility or Vega has the highest impact for at the money options. The further away you go from the at the money strike, meaning where the stock is trading, so either the further in the money, further out of the money, the less impact volatility or Vega will have on the price of that option. Okay, hopefully everybody understands that here, and I want to go through one more example here, and let's go back to our chart here in Apple. Okay, now when we're deciding to trade from a volatility perspective, we still need to do our analysis. We still need to do our diligence on direction, right? We still need to look at and see, are we bullish? Are we bearish? Or even are we neutral? And there are different strategies and different setups for each scenario. The key to remember for any scenario you want to be in, okay? The key is to remember that you don't want to buy expensive IV and you don't want to sell cheap IV. Okay, so when volatility is expensive, again, regardless of direction, regardless of whether you're bullish or bearish or even neutral, okay, you would rather have a position that is either neutral or short Vega. Short meaning you have sold volatility. Because the rationale behind that is if volatility is really expensive, we're looking at our charts, more likely than not, that volatility is going to decrease. So the options that you have sold become worth less. And when vol is cheap, you would rather have a position that is either neutral or long Vega. Long meaning you've bought options, you've bought volatility, because the likelihood is if you're buying volatility when it's at the bottom of the range, the likelihood is it's going up. So that is kind of a beginner's introduction into implied volatility. And I can't really kind of harp on and overstate enough how important it is to understand implied volatility with your trading strategies. In my world, and doing this for over 30 years, okay, my holy grail, if you will, okay, is when I can look at analysis, technical charts, fundamental, whatever it is, have a good idea of direction, okay, up, down, or neutral of a stock but then be able to combine that with an option strategy that gets me to whatever volatility position I want to have, long, short, or even neutral. And the combination of those two, in my experience, doing this for 30 years and being a volatility expert, that is how you can really, really jumpstart your profits and maximize those profits.
So let's start with the basics. What is a trailing stop? Well, stops in general are known as safeguards, right? There's different ways of utilizing them. One is to really just kind of define your maximum risk on each individual trade. But the trailing stop has a duality in terms of purposes, right? One is to define the risk in your trade, but it's also used to minimize the risk exposure. So, for example, if the stock does start to rise, your stop will automatically bump up with it. In relation, as it's moving back up, if you're a buyer, the stop moving up is actually starting to whittle down your risk exposure. If the stop ends up above your entry, like say you're long on Tesla at whatever, $100, for example, and the stop's now at 101, you basically have $1 in profit locked in. And as the stock continues to ascend, the stop will also move in accordance. So it's doing several purposes here, right? Obviously, you're defining your risk, and then the automation of that trailing stop, you are mitigating your risk. And even if you're manually adjusting it, if that stop does go above your entry, now you're starting to lock in profits. You're putting yourself in a position of power. You know, one of the things that people have struggled with, especially newer traders, is not locking in profits. Usually means that they just don't know, or maybe they do get too greedy. And B, they're always afraid of missing the big moves, so they're willing to let the stock really come back against them in anticipation, or in this instance, someone that doesn't know any better, maybe hope that it'll come back in their favor. And that's, something that we, as professional traders kind of just don't want to be married to. We just don't want to be married to one individual name. There's so many stocks that move on a daily basis. There's plenty of opportunities presented. We always forget, like we think that we're going to get rich off of one trade, and it's really not. It's a total collective body of work. So the trailing stop is going to be an asset, a tool that you could utilize to take emotions out of the situation, and really B, to take the greed out of the situation and put yourself in a position of power or a position of success. Now, let's explain what an ATR is first. ATR is a separate indicator, but the one that we're using is known as an ATR trailing stop. But I need to explain what ATR is first. So ATR stands for average true range. Now, there's different time frames that you could build it out. As you can see down here, I actually have mine over a 30 period, and I utilize it on a simple close. So basically it's just taking it from the close, but the ATR doesn't really care about the close. The focal point of the ATR is the extreme high and the extreme low of every single individual day. What it's doing is taking the total range. The total range is the highest price to the lowest price that the stock trades. So this ATR in my on my chart here is set at a 30 period. Now, because the chart time frame is on the daily, what that ATR average is, the average is going to be based on the total move the stock made or has made over the last 30 days. So this is important because now we know what the stock will normally move up and down in recent trading sessions. So when we see stocks expand beyond their ATR average, it's usually because something dynamic is happening, right? News, maybe, a breakout play, fundamental market activity. There's plenty of different reasons why a stock could really move beyond their ATR. But ultimately, when that happens, there's two things as a trader you must be aware of. Number one, there's a lot more money generally associated with the stock than there normally is, meaning the volume has kicked up a notch. There's a lot more institutional retail money coming in that is driving it beyond its moving averages. And B, when we see that expansion, it actually means that there could be breakout plays, potential short squeezes, potential buy squeezes if it's going down. But ultimately, something dynamic is happening. And when a stock is moving at a dynamic rate, the potential of pricing movement expands greatly. This is where we could see stocks that normally trade in $3 ranges, trade in $6, $10 ranges, and ultimately that leads to big opportunity. The beauty of that as well is that this big opportunity, in terms of return, won't happen over a month's period, but really happening in a matter of hours in certain instances, maybe even minutes. And some people don't like having that exposure, right, of their money in the market environment for over 30 days. Some people really want to get it in and get it out. Well, this is a good way of seeing when there's, dynamic opportunities being presented, when a greater than normal move could come into play, which means that you can make some pretty good profits in a very short period of time. So that's going to be super crucial here in the near term, that we recognize, more importantly, what the stock ATR average has been. Now, when we talk about the importance of this, again, when we see a stock not moving like they normally do, there's something taking place. When something takes place in a stock, there's such a different element that comes into play. One thing in particular is that we could see something known as a short squeeze. Short squeeze is basically when the market gets very, very one-sided. Ultimately, guys and gals, when we look at what a short squeeze is, we always anticipate it moving up, and it moves up at a great degree. There was a recent stock that moved from $10 to $17. It was Lucid. It was based on a rumor, and their ATR at the time was very small. It was less than, it was like around 50 cents. And of course, a $7 move came in. So imagine the leverage that you could get with the stock that normally isn't volatile, right? Going from $10 to $17, and all of that taking place in an hour. Well, in terms of the option market, this is a situation where options that were extremely cheap, right? We're talking about 10, 15, 20 cents per contract are all of a sudden trading at $2, $3, $4, $5 in a very short period of time. The ability to leverage a stock that's $10, right? You could buy a lot more of a $10 stock than, let's say, a stock like Apple that could trade anywhere from $80 to $100, right? If it's trading at $100, that means you're getting 10 times as many stocks as you normally would if you were to buy Apple. So imagine that leverage and getting the same type of move as a stock like Apple and Tesla. This is extremely important because when we recognize that the market is getting one-sided, that is now leading to something dynamic. It is leading to opportunity. It is leading to huge profit potential in a short period of time. And some people don't recognize this, but one of the earliest ways you can pick that up is when a stock is now trading greater than the ATR. Now, so if we look at the ATR, folks, right? And the way we can recognize it is if that ATR, for example, is 50 cents, right? And all of a sudden we look at the day's range and it's $11 to $10. Well, obviously, we now know that we are double what the ATR is. So on screen right now, we have Baidu, okay? So if we look down here at Baidu, their ATR is currently at 5.82. So that means on average, Baidu moves $5.82 a day from high to low, okay? So high to low. Well, today, so far, the total range, you could just actually see it right here where it says R, right up here. Sorry, I'm trying to draw with this on this desktop. It's $9.86 today. So we have expanded beyond the ATR by $4. Early on, you could see that it jumped. We traded initially at the lows of 145 and immediately ran up to 154.86. Just a huge move on news. Today, I believe that they had news that BlackRock took an investment in the company. Yesterday, they had news that they were working on some AI project and development. All of this has led to obviously a high level of demand. But now, if we actually kind of combine that with the short thesis, well, Baidu was getting knocked back over the last 2 days. Baidu went back down from 142 down to 132 in 2 days. So as you can see, it jumped to 145. We got up from where it actually started to roll over to the downside. We were above that level by $3. So short sellers, recognizing that they're in a bad position, knew that they had to liquidate at the open. And then the buyers are like, well, look at where it's opening. There's huge potential because there's a lot of room to the upside. If you notice from where this moment is to the purple lines here, there's a lot of space. And so the short sellers recognize that moment. They decided to exit. Buyers recognized the opportunity. They decided to come in. And this is what I mean by the market getting one-sided. When short sellers, or if you are short, you need to cover your position or exit position, you have to buy back your position. So if you're short, to exit, you have to be a buyer. If buyers want to get in immediately, what do? They have to buy the market price, whatever the current market price is. So as you can see, at that moment at the open at 145, everybody raced in on the buy side. And next thing you know, the stock is trading above 150 and as high as 154. That was very important. Once it crossed 150, right, that basically told buyers that there is a possibility for way more upside in the near term, not just based on the chart, but because we're already basically at our daily average ATR. Once we got beyond that level, buyers knew that something dynamic was really occurring. And so they started piling in, and boom, next thing you know, another 4-point jump from that moment. This is really important, folks, because if we recognize once stocks expand beyond that ATR, we know that pricing movement could be very, very significant. Now, what does this actually have to do with the ATR trailing stop? So it was really important that I expanded on that ATR because that ATR gives us an average on what the stock price moves. The ATR trailing stop is actually very different. Some of you probably already know what a trailing stop is, but an ATR trailing stop is a different variable of that. Generally speaking, with trailing stops, there is a specific condition that you have to write in or set it as, meaning stock moves 35 cents, the stop will bump up 35 cents, right? And it's that preconditioned specific pricing, whatever you guys do. Maybe you want to do 1% or 5%, regardless of what it is. People generally have it automated and they have it same across the board. This is mistake number one, folks. Not every stock trades the same. Even though AMD and NVIDIA will generally move in sympathy, meaning if one's going up, the other's going up. One's going down, the other's going down. The difference between the two is that while AMD may move 35 cents, NVIDIA will probably move $1.50. Yes, the moves are sympathetic. They're very similar, but the amount of price movement is extremely different. Same stock, same sector, but they cannot have the same trailing stop. This is something important that new traders need to recognize. One size does not fit all. The ATR trailing stop plays an integral role in this situation. Because of the ATR trailing stop is actually intuitive. So what I mean by that is that it's actually self-adjusting in accordance to the stock itself in terms of pricing behavior. So what do I mean? Well, the ATR trailing stop in NVIDIA may have a lot more room than the ATR trailing stop in AMD. Again, both stocks are very same, right? They're very much the same. They're in the same sector. They're the same type of business, but the difference is one moves much greater than the other, meaning the volatility in one is much bigger than the other. And because of that, you cannot utilize the same trailing stop. Now, even on a percentage base, which you'd be like, oh, well, what are we doing on a percentage base? That will self-adjust it. It won't. Quite honestly, there will be situations where NVIDIA and AMD may trade totally polar opposite of each other. Again, the stop should be intuitive to how that stock behavior is, because there could be news, there could be analyst notes, there could be earnings, there could be I don't know, someone comes out and makes a specific investment in that particular company that can move it much more or cause the stock to tank. Whatever it is, every single stock has their own lifeline. So while they're generally moving in sync with the broad markets, they don't always have to. They always have their own source of news, their own source of trading, their own source of institutional investors and traders that are actively trading that name every single day. And because of the pricing discrepancy, because of the volatility, things may be different. And so that ATR trailing stop is extremely intuitive. It'll recognize if things are not the same, that if volatility does kick up, it will self-adjust and account for that volatility. And that's extremely important in this scenario. Now, I actually call the ATR trailing stop the greatest indicator I have worked with. And yes, a trailing stop is that great indicator. The reason being is that it helps me get on that correct side more and more often than anything else. Now, there's two different variants of using this, all right? As a straight up indicator, it's going to help you get on the correct side more. And number two, it'll also help you recognize when the market sentiment has shifted on that stock. Again, let's take a look here. I am going to erase everything that I wrote. Now, you could actually see here, and I'm going to delete a lot of these. Let's just pull all these off here just really quick, all right? Yeah, we'll just leave it like this. Give it a clearer picture here. Now, what I want you to focus on are these teal and purplish pink dots here. That is your ATR trailing stop, okay? So when the stop is below the market price, or in this instance, if you could see the color, the ATR stop is blue, that means we should be a bull or bull bias. We should be looking up in this situation. We should be looking to buy the dips, play breakout trades, et cetera, et cetera. We should be looking to the upside. That's what the ATR trailing stop is saying. But if you notice here, folks, right in this situation, right where I'm highlighting with that circle, we went from blue to pink. Now the ATR trailing stop is above the market price. This is actually suggesting that we should be a bear on the stock, that we should start speculating that the stock price is going to go down. It's assessing the risk to the upside. So if you are short, your stop is going to be above your entry price. If you are long, your stop is going to be below your entry price. So notice how at that moment we went from blue to pink. Now, if you notice at that moment, that was right around, let's say around $120. Since that shift, it went from $120 down to $73.58. The time frame, about 4 to 5 weeks. Now, if you look at where I'm highlighting with the blue circle, notice where at that moment it went from pink to blue. That was right around the $100 mark. Since that moment, over the next 2.5 months, we've gone from $100, currently now trading at $150, $170. Or it basically gained 51.7% since that moment. It's extremely accurate. Now, it's not 100% accurate. And during extreme volatility, there are chances where it could flip from blue to pink to blue to pink. Now, respectfully, under extreme volatility, anything goes. It's really hard pressed to say that any indicator is going to be wholly 100% reliable in those situations. But you could see, even during the volatility, how fairly accurate this is. Let's actually point out the cues over this situation. Now, you can see the volatility has taken place, but look at the transitions prior to, and look at the pricing movement that took place afterwards. And in this situation here, you can see that the volatility has reigned supreme. It has caused a little bit of a fake out. And you may say, well, I can't rely on it. Listen, guys, come on. If I actually pull this out and give you a broader picture, you'll see how rock solid this is. Now, let's put this on a 2-year time frame. Let's maximize the sell here and expand it a little bit more. So let's start from here. We saw that it flipped down. It ended up working from around 360 down to around 340. We flipped it right around 360, went up to 408. Okay. So we had those transitions, smaller downside, bigger upside. Now, if you take a look, going into the start of 22, we actually had flipped. We had flipped, I believe, in late November, early December. From that moment of the quote-unquote cues flipping, that was near right around let's say around 390. The cues ended up dropping down as low as $318. On that flip break on the bear market pop, it only ran up for about 20 points. But when it flipped again back here, and that's the reference, once again, the Q slide from 335 all the way down to 268 was very prominent. When it flipped back up again, we went from 310 up to 332 in about 2.5 weeks. And then finally, when we broke down the last time right here, okay, the market went from 303 down to 259. Again, look at how fairly accurate this has been. And look at how sustainable these runs have been. Even in the face of extreme volatility, it certainly has given some really strong guidance. This is extremely important to recognize, because if you are buying during these situations, well, imagine you had this information on your hands that would have told you maybe now isn't the time to be a buyer just yet. Now, certainly we could look for reversal signs. Those are always going to be key to buy off lows. But respectfully, the buy with confidence is when we see these moments turn over. A name that I extremely love has actually showcased weakness for far longer than most people probably anticipated. This is PayPal. If you're not familiar with PayPal, you probably never used any of their services, but most people are familiar with PayPal. So if you actually take a look, going back here after their all-time high, the stop ended up flipping on July 29th of 2001. It was suggestively saying, start looking to the downside. Again, that had occurred right around $282. Before it ended up flipping, it got down as low as $92.25. Nearly a 200-point runoff. That was till March, from July to March. Now, you've seen we've had some transitions here and there, back and forth. That's along with the overall broad markets. The transitions overall have been actually pretty decent, but what was really key in this factor was that initial warning and break off the highs. So if you were an investor on PayPal or you were a long-term trader on PayPal and you recognize this, and imagine you were long at 180 bucks or 200 bucks or 250 bucks. Imagine the heartache that this indicator would have saved you as this stock was plummeting and losing 2/3 of its value in less than a calendar year. So now you may say, well, is this only good for the daily chart? That's an important fixture here because it's not always going to be important for the daily chart. The beauty of this is that the utility can be used for any time frame. Day traders, if you trade on a 1 minute or 3 minute chart, imagine what's taking place here. Imagine the volatility indication here. Now, it may not be as ongoing and sustainable, but again, if we see that back and forth swinging back and forth, we obviously know that the market is A, swinging up and down and not giving us direction, meaning it's volatile or choppy, or B, that there's something that's not healthy in regards to the stock. So let me pull up AMD. AMD had earnings here. And what's beautiful is that guys and gals, if the stock is trending, well, imagine being able to hold throughout that entire trend. A lot of people sometimes get a little nervous. They let go of money or let go of their positions a little bit too early. And this is a good way of truly knowing when the heck you should get out. This also could help you hold strong. Well, here's a case earlier, pre-earnings, that AMD in pre-market ended up getting that blue stop right there. And if you would have bought it early here, you would have literally held all day long because there was no reason to get out. Let's look at the recent run-up in Tesla here, both up and down. So we have seen the utility in Tesla play in different ways. Tesla, just a few days ago, made a substantial run, basically running from $165 to $180 in one day. Now, knowing your upside targets, that's up to another lesson. But most notably, if you actually look at this, this is Tesla on a 3-minute chart. If you notice, the stop has remained blue. If you recall what I said earlier, when that ATR trailing stop is blue, we should be bull bias. So if you were holding early on in Tesla and we got this run, most people will be like, oh my God, I'm up $4 or $5. Let me take the money and run. Some people will hold strong because they're greedy and they want to maximize it. But for those that need a wake-up call on when to get out, this ATR trailing stop indicator will actually tell you, okay? And more importantly, this utility works in both directions as well. As you can see, Tesla had one moment the following day, which was on Monday, or the following trading session, which was on Monday, where it was blue. Well, the stop flipped pretty early within the first hour of the day, and then that led to that cascade on down. So imagine if you were short Tesla, how much you could have capitalized. The following day, Tesla went from pink to blue. We basically went from 167 and rode it all the way up to 174. And you could see here right now, Tesla ended up flipping that stop. We ended up working a little bit lower. That stop flipped at 172, got down to 169, and now we are still settled, still slightly bearish in the near term. Notice, folks, that AMD is up. Here's AMD, and they have their blue stop, but Tesla is pink. That's why things, right? Stocks don't trade the same. More importantly, we are accounting for the volatility. We're counting for the actual stock performance. It is self-adjusting. It is intuitive. I gave that comparison about AMD and NVIDIA. So NVIDIA right now is actually projected to move down. AMD still has their blue stop. NVIDIA has turned down. So another key factor here, I want you to take a look. We have double topped here. We have double topped here. We're also making lower highs, and now NVIDIA is working lower. NVIDIA currently is about $2 off of their highs. If we look at AMD, well, they're about 40 cents off of their highs. Again, AMD stop below is blue, still trying to turn up here. NVIDIA stop is pink, trying to work down here. NVIDIA is actually showing weakness. AMD is showing strength. They're very, very similar companies. Generally, they move together almost on a tick by tick basis, up and down, usually sympathetic. But now something is happening. NVIDIA is working a little bit lower. The markets are probably working a little bit lower here. Yet AMD is showing strength. AMD is projected up. NVIDIA is projected down. This is a good example of exactly why this stop is so amazing. And it's not just because you could calculate your risk. That's actually the icing on the cake. Remember what I said. This is the greatest indicator I've worked with because it's going to help me get on the correct side of the market for that stock more often than not. Now, it's not 100% guaranteed, of course, but it certainly has that ability of having a high level of accuracy. All right. So now, folks, we got to understand, right? When we defined the benefits of a trailing stop, I broke down what the ATR is, and now we married these together, and I explained why it's so important because they're intuitive. We just got to say 2 plus 2 here. When we talk about things being very straightforward, don't overthink it. If it's blue, we should be bull biased. If it's pink, we should be bear biased, meaning if it's blue, we should be looking to be a buyer. If it's pink, we should be looking to be a seller. Doesn't mean that we automatically jump in. In some situations, we could warrant that, but certainly this is just one portion of the puzzle. This is a big portion, but ultimately as traders, especially if you're utilizing a array of indicators within your trading, that's really what an algo is. An algo is taking different data points and looking for that one sweet spot, that high percentage, high percentage of accuracy. We don't want to guess here. Everything in terms of what we teach at Prosper Trading is usually rules-based. These things are there as safeguards. It's because we have a high level of accuracy when the stars align. And when we expand beyond those levels, where we're opening up a different can of worms, we're not taking the same context. And ultimately, it just becomes more guessing. Certainly, trading always has elements of speculation. That's exactly what trading is. But if we break it down to the core, us as traders, especially people that are using chart patterns or using indicators, there is a rhyme and a reason of why we want to get in, none of which is going to be, I want to buy, so I'm going to buy. I want to buy, but I need to qualify my buy. One of the questions you may be asking yourself is, what is the ATR trailing stop doing now? What color is that ATR trailing stop? Is it blue or is it pink? Well, if the market is moving up, we have that ATR blue, we get your other indicators that are suggestively saying bullish, and now it's actually created a buy-side opportunity, an actual signal where you can define your entry and your risk. Well, you're left with one thing. You either pull the trigger or you don't. It's a great situation to be in as a trader. Trading with clarity, trading with structure, trading with the odds in your favor. Some people may say it's guesswork. I know. I like to say is that we are trading with the odds in our favor. Calculated risk, I guess you want to call it. Truth be told, we are seeing a historical average replay over and over. And the probabilities that came from that historical average is what we are utilizing in that situation to either be successful as a trader or not being successful. Obviously, we want to be successful. So let's swing those odds in our favor.
Hey everybody, Scott Bauer here from Prosper Trading Academy. Today, we're going to talk about a strategy that I love to use, and that is called a diagonal. Diagonals can be used for moves to the upside or downside, either way. We're going to discuss a put diagonal today, but in general, many traders get very frustrated or scared about the name of a type of strategy. Oh my God, I can't understand that. That's too complicated for me. Diagonals could be one of them. But when you actually break down these types of strategies just to their basics, it makes it so much easier. So let's go inside here. Let's go to the whiteboard and take a look at what a diagonal spread is and what we did here in GLD. And we are going to discuss a diagonal option strategy. Okay, so diagonals are really the combinations of two things. It's a combo of a calendar spread and a vertical spread. For those of you that don't know what calendar spreads are, calendar is buying time. Basically selling an option with a expiration that maybe is a week or 2 weeks out, okay? And then buying that same option, buying that same strike option further in time. So you're creating a calendar. You're buying time. Okay, so that's what a calendar is. Again, creating time. Same strike. However, we also know what a vertical is. A vertical is using a spread with the same expiration and two different strikes. Okay, so we have a combination then of a diagonal of buying time and using different strikes. And the reason that we do this is to buy time, especially when option volatility is cheap. We want to buy time. Options cost less. But then by using the vertical part of this spread also, it really gives us more direction to where we want to go. So check this out, everybody. Okay, what we did here in GLD, if you can look right here up on the screen here, GLD is actually the ETF, a gold ETF. And you can see on this big rally up recently, we came right up to the 200-day moving average, which for months and months and months, this blue line here, the 200-day moving average, has been massive resistance. So right here was our entry point, right around 168 on this blue line. And what we did when it hit right up there is we wanted to buy a downside move, a downside play in gold based on the resistance level right here. So that's exactly what we did. And the way we structured this was doing just this right here. We sold an October 29th expiration, 162.5 put. We also, to complete the spread, bought the November 19th expiration. So that right there gives us our calendar, selling October 29th, buying November 19th. And we bought the 165 put. So that gives us our vertical right here. So we have a combination of a calendar spread and a vertical spread. So that gives us direction to the downside and buys us time. And you can see right off the bat here, look at this move here, right from this massive resistance right here around 168. And literally in a matter of a day, You can see what GLD is doing right now. It's down 1.5%, down $2.26 right down here. So we had bought this spread yesterday for $1.30. It is now trading $1.80. We are going to get ready to take some partial profits right here and look for a further decline in GLD. But that's what really wraps up and explains what a diagonal spread is. Again, a diagonal being the combination of both a calendar spread, so buying time, and a vertical spread, giving us more direction, whether we use calls to the upside or puts to the downside.